We were looking through your research the last few hours, and one chart that really stood out was the exposure of some of the Gulf countries to the China coronavirus story. Saudi Arabia at the very top of that list, the most exposed. Is it a bit of a rude awakening for those who were expecting this kind of resilience in the Saudi economy?
I think it's definitely a source of concern. I mean, we've been well aware that the Middle East region, the oil exporting countries in particular, are import dependent. Their economies are very much import reliant. So that's certainly been something that's always been in the back of our minds. For Saudi Arabia, as you correctly point out, it is the most reliant there in terms of the imports from China, and that does set them up for knock-on effects of supply disruptions coming in from China. By and large, though, we still feel that overall Saudi Arabia is more well-positioned to weather the storm in terms of an overall impact on GDP. Versus its neighbors, simply because of its ongoing reform story. It has a greater reliance on, in terms of, if you look at the consumer staples division, there are several companies that are much more vertically integrated. They bring about less exposure from a company-specific level on imports from China. So I think it's not entirely correct to look at just one specific aspect. I think if you look at the overall GDP exposure, Saudi Arabia does certainly remain well-positioned in relation to the rest of the Middle East.
As we see policymakers take more steps, we saw some of the religious visits being put on hold. The Fed cutting rates, the emergency move there. SIBOR has already been coming down. That's the interbank rate over 3 months. We're down below 2% easily. Now we're close to 1.6%. Net positive then, this rate cut for the Saudi economy, would you say?
No, I think this is more about managing the crisis as it unfolds. I think a rate cut was very much on the cards anyway. But, you know, the central bank's actions aren't enough to actually bring about a stabilization or a recovery in the economy. That's something that has to be government-driven, that has to be fiscal spending-driven as well. The central bank's action, obviously, it's positive. It helps in areas where there are liquidity dislocations. It does certainly help the economy in terms of borrowing costs, but it on its own is not going to be sufficient. There is going to have to be a wider sense of intervention from the government, and that's something which we expect to be forthcoming over the coming next week.
But there's not going to be a windfall from any oil revenue. I mean, it looks like oil prices are going to be range-bound and perhaps even lower than some would have anticipated at the beginning of the year.
Potentially. I mean, we still think there's a good chance of a rebound in oil prices. Obviously, it's heavily dependent on what the OPEC decision is in the end. We do think that there is a good chance that we see a rebound in oil. You may well see the market more well-balanced this year. There is obviously a risk next year. We're a little bit cautious looking ahead as well. But you're right that either way it goes, there is going to be a negative impact on revenues. And we don't think the focus that we've seen over the last few years on rebalancing the fiscal deficit and increasing the exposure to the oil economy, that's obviously a long-term trend, but they're going to have to deviate in the short term to manage the outcome of to manage the impact from the coronavirus on the economy.
So where does that leave some of your conviction calls? You had switched to going long on the United Arab Emirates just about a few months ago.
No.
At least you were more upbeat.
We were more upbeat.
You were more upbeat. Have you
changed
anything with your allocations? So, UAE and Egypt specifically?
Yes, that's right. So Qatar, we have become more cautious. UAE, we've maintained that sit and wait approach. Egypt, which we've been long-term bulls on, we eventually had to call that and bring it down a couple of weeks ago, down to neutral, because it seemed, you know, with UAE and Egypt, both of them so heavily dependent on tourism, that was a significant risk. So we've had to pull back our positive views on Egypt in particular. Saudi Arabia is a market which we've been focusing on a lot, because there you do have this strong reform story, and that's something that investors really need to focus on in this kind of environment, especially. It hadn't reached the stage where we are comfortable enough to go full-on positive. Obviously, now we're having to wait even further. It looks like it's a second-half story rather than being a second-quarter story. Egypt certainly remains interesting from us from a T-bill perspective. That's something that it's certainly not a defensive or a low-risk strategy, but in this current environment where you have a great deal of currency volatility, there are defensive-like characteristics just arising from the fact that the currency is in a managed float. But obviously, it's not risk-free by any stretch. It is susceptible to outflows of hot money, which is essentially what it's relying on. So that's obviously a major risk, but it's still an attractive trade for us.